Hi, everyone, and welcome to the first week ahead of 2025. I'm Tony Nash. Today, we're joined by Tracy Shuchart, Jim Welsh, and Leo Nelissen. It's a new year. Equities are kind of meh. Long bonds are way up. The 30-year is up almost 100 basis points since the start of Q4. It's really interesting times. Of course, we're a couple weeks away from Trump's inauguration, so it seems like a lot is about to change. But really, let's just see what's going to happen. So we've got some great key themes to kick off the new year. First is energy directions. We've had some news about energy supplies and storage and stocks in the US, and I want to talk through that with Tracy and see where we see energy prices going. Jim's written quite a bit about equity markets euphoria, so I want to dive into that, and we'll get into valuations and a few other things. And then Leo's been talking about warnings for dividend investors. So I think we've got a little bit for everybody in this show, which makes me happy. So Tracy, Jim, Leo, thanks for joining us. I'm so grateful that you could take the time to do this.
It's great to be here for the first episode of
Yeah,
the year.
that's right. Exactly.
Where's the drum roll?
Yeah, I would try it, but it would sound terrible. So, okay, Tracy, recent data indicates a notable decrease in US crude inventories. This was in December, of course, with a reported reduction of just under 1 million barrels. I think it was last week. So Reuters, of course, is doing their best to kind of stoke panic or whatever, saying there are decade lows and all that. So with this, coupled with we have geopolitical tensions in the Middle East. We've got Russia, Ukraine still. We have a lot of questions around the transition in the US. We've got questions around Northeast Asia with Korea and China and Taiwan. We've got cold weather, which it's winter, but cold weather always, makes the news. We've got fires in LA, all this stuff. So one would think prices would just reflexively jerk up with that, and we'd have a really bullish outlook. But analysts like JP Morgan have a bearish outlook for oil prices in 2025. They say Brent's going to be around $73 a barrel. So I'm showing a WTI chart right now, mostly because we're Americans, but just showing that we're not seeing a massive uptick in oil prices as a result of that. So why is this? Why are crude inventories so low? Why the buildup in refined products? And what is it? Does it mean anything for 2025, or is it just a one-off?
Well, I think we need to separate this
Okay,
into
good.
several categories.
Good.
So first off, we need to talk about, generally we see draws by the end of the year because the tax assessment date for barrels on hand for all these producers is December 31st. So usually the back half of December, we see them trying to get rid of as many barrels as they possibly can, which is also why we see these big builds in product stocks, because they're just feeding as much as they can to the refineries because they don't want to be taxed on the barrels that they have. And so that's not irregular by any means that we haven't seen in every other year, just because of that factor. Another factor I want to point out that a lot of people aren't really talking about is the Cushing stocks. Now, Cushing is the actual WTI contract that you are trading if you're trading on CME Group, right? And that's why it's kind of pulled out of total inventory numbers whenever we do inventory numbers. I know some people have asked me recently, why do you have crude oil and Cushing? Well, it's because Cushing is the actual contract that you are trading. Now, when we look at this particular contract and we look at Cushing, and Cushing is a storage in Oklahoma, it holds 90 million barrels. That said, you need room at tops of the tanks to transfer these barrels. So we'll say working capacity is actually about 75 million barrels. Now, we just hit 20 million barrels in that storage, which is all-time lows. And when we talk about what is the tank bottoms, we talked about tank tops is 90, but you can't really do it. What does the tank bottom mean? The tank bottom means it is about 10 to 20% of total capacity. So we're pretty much almost there. So it is surprising that we haven't seen oil prices spike on this, but I think a lot of that has to do with traders don't exactly know what exactly the contract they're trading, to be honest with you. And then the third part of this equation is, how positioning is right now. We're going to see a short squeeze over $75 in WTI. I'm talking WTI because we're Americans. um, and we've seen over the last couple of days, they've really defended that area, right? Just, if we're looking at this on a technical basis, you know, I think we could possibly see, another $5 short squeeze above that just based on positioning in general. That said, and I've talked about this a million times, I'm totally happy if we see WTI stay in this, say, 70 to 90, we'll give it 90, I would even say $80 range. Everybody's making money, everybody's happy. Oil companies or shale companies are going to make money. It's great. And so that's kind of the other part of the equation that you have to look at on the equity side of this industry and say, well, it's much better. I don't want to see oil over $100 a barrel. I don't. It's terrible for every economy, particularly emerging markets. And we don't want to see that kind of volatility. Now, if you're a trader, you hate this market right now because
Boring.
it's boring. But if you're trading equities and looking at kind of the bottom line for these companies, they're making money. And so I know it's still an unloved sector. We've seen a big pullback in the equities in the back half of H2, but I think that still it's, these companies are making money. People like to see a relatively stable oil market. So
Less drama, right? So Jim, Leo, jump in here whenever you want. But Tracy, I have a question for you about, you talk about you don't want to see oil above $90, but also in an environment where we have a 109 DXY, that seems like it would kill emerging markets. Is that right?
Well, absolutely, because what their debts in USD denominated dollar debt. And so particularly if you're not an oil producer, that's really killing you right now.
Yep.
If you are an oil producer, then at least you're getting dollars for those barrels because oil's traded in USD. So that's kind of keeping those countries afloat, but it's terrible for the other countries that are not oil producers.
So if that happened, and not just EMs, but if that happened, and we look at, say, continental Europe or Japan, it's even more dire for those guys as well, right? Given where the economies are, given where their fiscal position is, all this stuff, how much pressure does it put on those? Well, Japan as a country, EU as a multilateral or nation, whatever group of nations. How much more pressure does it put on those guys?
Well, of course, it puts a lot of pressure because those groups, well, the EU and Japan,
Yeah.
country, they're importers. They're
Right.
not producers. That's going to put tremendous pressure. And, I think Japan already sees this. And this is why we're seeing kind of that shift to nuclear again, where they're reopening nuclear plants and things of that nature because of the volatile oil and nat gas prices.
Yep. And that brings geopolitical pressure too, right? Or political pressure, domestic political pressure,
right.
I would think,
A
because we're already
question.
seeing fiscal issues and budgetary problems, Korea, Japan, Germany, France, et cetera. So Jim, go ahead.
It also creates some problems for the central banks.
Yep.
From a standpoint of those importing nations are going to see higher inflation with oil prices if it does go up. But here's a question, Tracy, and thanks. I love listening to you because you provide a lot of great information. But here's my question. Donald Trump campaigned on the idea that he was going to bring inflation down by cutting energy prices in half and so forth.
Yep.
At the same time, over the last 5 to 7 years, oil companies have really gone in a different direction in terms of we're not going to drill like crazy. We're going to buy back stock. We're going to pay dividends.
Right.
And I suspect that when he asks oil companies to increase exploration, they will enough just to kind of keep him off their backs type of thing. But that to me almost sets up a situation where the risk could be upside, but yet the perception of his comments, I'm wondering, and this is my question, people thinking, well, he wants them to increase production, and that means, but and oil prices are going to go down, and he's going to get his way. Is that influencing, you think, people's outlook over the next year or two?
Oh, absolutely it is. 100% it is. And that's why we're seeing positioning the way that it is right now, because people are so
Yeah.
worried because he wants another 3 million barrels per day out of US shale. I will tell you 100% that's not going to happen. It can't, it's like physically impossible for that to happen, based upon what is happening in the shale patch right now. We've had a lot of mergers and acquisitions,
Yep.
particularly after that 2014, 2016 kind of dive in
Plunge.
oil prices, right? I didn't know how to express that, but and that wasn't the first oil crash that we've had. That was the second oil crash that we've had. And companies, we have I believe that why we have seen oil production increase in the US is really because these smaller shale companies are just still gung-ho because they want to be eaten up by the larger companies. So in other words, I'm Chevron. I don't want to spend any more money on CapEx. I've talked about this a million times, or Exxon, or any of the majors. So what am I going to do? I'm going to go buy all of these wildcatters out, and I'm going to buy production instead of creating production, instead of CapEx layout, et
Yeah.
cetera, et
I mean,
cetera.
that's really an important point because the wildcatters were the ones that were the most aggressive in terms of bringing new supply on.
Right.
And as
And
their
now,
ranks have shrunk,
yeah, now that pool has shrunk because
yes.
we've had huge M&A since 2016, and particularly over the last couple of years. I mean, some of the biggest wildcatters have already been eaten up. So
Yep.
that's kind of, that era is kind of over.
Right. But it kind of, to me, again, it sets up the potential for upside surprises.
Right.
And it also has implications, which I think Leo will probably talk about. In the past, when they would drill like crazy, oil prices would in fact come down. And so the fact that that hasn't happened, not likely to change materially, it suggests that inflation from energy won't provide the relief that it has in other cycles, following a big surge of investment. And, that means that inflation will be more stubborn, at least from that sector.
Yep.
100% it will. And, when we even had, like, Exxon came out, it was like a month ago, and said, yeah, we don't really care what Donald Trump says, but we're not deviating from our current path,
Right.
in the shale industry. So it's not, I mean, that sounds great. Drill, baby, drill. We're going to get energy prices down. But, this go around, energy companies are not falling in line with that sort of thinking, and that's not where they want to be. I mean, you know, they've suffered a lot unjustly, I believe, in their stock prices, even though, they've really cleaned up over the last few years. And so they're not going to, hinder that sort of
Yeah.
success that they've had.
Yeah. Yeah. That's
So
why I think,
Tracy,
just
sorry.
politically, they're going to do a little bit just so that, hey, we did increase our CapEx budget by 8%. Woo-hoo,
Yeah, 8% in West Africa or in
Yeah.
East South America, right?
Yeah, right. I mean, they got to do something just so they can say, hey, we listened, we heard, and we acted. So don't jump on our backs.
Right.
Leo, go ahead.
Tracy, how big of a factor is OPEC? I mean, they have some spare capacity after cutting production, right? Isn't it possible for Trump to just, I don't know how plausible it is, but to just cut a deal with them that they somehow deviate from that plan to, I don't know if they're still pushing for $80 Brent, but for them to increase output by 2 to 3 million barrels or something? Is that possible for OPEC? Would they do it?
That's a very good point, Leo. And I think that's also on investors' minds as well, is because they're worried this OPEC plus alliance is going to fall apart like it did in 2020, and lead to disaster, or how, OPEC in itself had a lot of cheaters in the past. I have said, and I strongly believe since 2020, that, they're serious this time. Like, I think 2020 really taught them a lesson, but I think investors, I think people are scared. Yeah, there's 3 million barrels off the market. If they decide to increase production by any means, and we just saw this a few months ago at the OPEC meeting when they said, yeah, well, here's our plan for 2024, and the market immediately hated it. So, and I think they're very well aware of that, and that's why they kind of keep pushing off reintroducing these voluntary cuts back into production. So I do think that they're going to stay the course as long as they need to, because all of these countries also think, a lot of these OPEC countries have a lot of these big projects going on, and they need oil prices as high as they possibly could get them right now, because they're looking at expanding into tourism and things like that. So I think it's a totally different mindset, and I think they're going to be very conservative, as they have been.
Thank you. That's great.
Yeah, that's really interesting. Tracy, I also want to talk about nat gas for a minute, because it's cold. We see nat gas consumption in the US and Europe, expanding. We've seen nat gas prices up. I think that today they're at 4.30. In October, they were at $2. So can you give us a little bit of kind of narrative? Is this just, I know nat gas is volatile, but do nat gas traders not understand that winter happens every year? Like, why do we see this volatility right now? And I say that kind of seriously. Like, why do we see it when it's cold? And is that just paper trades, or does actual physical nat gas for power generation move this much because of the weather?
I think a lot of this is paper trading,
Okay.
because of, if you look at the cycles of the infusion to our storage, and whatnot, is, it's not just because it's cold, this nat gas traders know that you just don't
Right. These are smart
don't
people.
you don't do the weather trade. What
Right.
I think is very beneficial, or has been beneficial for the US as far as nat gas is concerned, is the export capacity that we built out, for LNG. And of course, after the Russian invasion of Ukraine, and Russian gas is still flowing in Europe, but we've seen big buyers, particularly from Germany, for US LNG. And so, of course, that's helping boost prices. Also, if we look at TTF, the European natural gas contract, it's trading much, much, much higher. And so that's also helping push up domestic prices as well. And we've had a ton of pipelines built, natural gas right now. If we look at, for a lot of this year, we had Waha natural gas, and people think all natural gas is the same in the US. It's not. We're trading one contract, that's Henry Hub, but Waha natural gas was stuck in the Permian forever until KMI completed their pipeline. And we did this in a little over a year across 13 counties to the Gulf to get it out. And now Waha prices are back positive. And so, again, I think exports have really helped the United States right now. And I think that's helping lift prices. Are we going to see natural gas prices anywhere near what we're seeing in Europe? No, but because we have so much of it, but we're off that, $1.50 floor. So.
Right. Okay. That's all super interesting. I think a lot of people look at the nat gas market and they go, Widowmaker, a lot of volatility. It's really scary, a lot of drama. And I think it really helps to get that perspective on it. So thanks for that. So Jim, Thanks. It's great to have you back. So glad to have you back. And I know you're based in Southern California. I'm so glad you're not affected by the fires in LA and all that stuff. I was reading one of your recent notes, and you talk quite a lot about expectations and euphoria and valuations and all the scary stuff right now, right? With values where they are, right? So
Yeah.
you talk about the euphoria meter. And I've got it on the screen. So can you tell us a little bit about this and what is it telling us?
Okay, let me preface this and try to put a framework into it, Tony. And first of all, some of the stuff we're going to be talking about, I have a special report called The Coming Secular Bear Market, provides a lot more breadth and detail. So anybody who wants to receive it, Jim Welsh Macro at Gmail, I'm happy to send it out because I think we're nearing a very important inflection point in the equity market. And the context is most people believe markets discount the future. You listen to any person, and it's almost nonstop that, oh, the bond market's telling me this or whatever it is. And the reason why that is so accepted is because 80% or 70% of the time it works. When you're in the middle of a move where the economy's doing just fine or the economy's doing awful and the news is either good or bad, markets reflect that. But at turning points, the majority is always wrong. So the concept that markets discount the future fell investors at exactly the most important time.
Jim, it sounds like you're not going to make it. Like you didn't YOLO on Fartcoin, and I just don't know what to say here because I'm just shocked by that.
Well, you see this gray hair? I'm actually 32 years old.
Yeah,
So
you look about
anyway,
10, 20 years younger than me. So
if only. But my point, Tony, is what helps people identify tops and bottoms? And to me, it's contrary opinion. And the reason why contrary opinion is so valuable is because it's really hard to do. You have to go against the consensus, the narrative. And in order to do that, I have found I need tools. And watching sentiment and things like valuation when they reach extremes, technical analysis, and obviously looking at monetary policy, what's going on in the economy. All those things can blend together to be supportive of taking a contrary position. So that's a big build-up to the Euphoria meter, which is a chart produced by Top Down Charts. He does some great work, so I would tell anybody check it out. And he's combining a number of, if you will, sentiment indicators as well as forward PE ratio on the S&P. And it's just a reflection of psychology at any given time. And it's showing that we're at an extraordinarily high level of euphoria, I think higher than we were in 2000, which is always a good benchmark to go. So that to me is a yellow caution sign that everyone is kind of on board. And the thing I would note is technicians will look at the euphoria meter and fundamentalists look at valuations. Very, very important. But the thing about technical analysis, which I think is so beneficial and necessary, is it provides the underlying strength or weakness in a market. So the point being is you can get a lot of people being euphoric, and it can go higher. Valuations can go higher. So the litmus test for me has always been trying to find cracks in the story and then relying on technical analysis to start to see when the underpinnings start to weaken. Because markets don't go down because they're expensive. They don't go down because people are excited about things. They go down because people are given a reason to sell. And again, it's in the context that mutual funds, pension funds, most investors have been indoctrinated to buy and hold forever. And so it's a long only bias. So to get people to deviate from that, there has to be a reason to sell. Small reasons get you 5 to 10%. Recessions, monetary tightening, or obviously some kind of a credit event, that gets you the 20 to 30% variety. So to me, the euphoria meter is just telling us that, all right, we're in the zip code that caution is warranted.
Yeah, I think indicators like this are really interesting. good directional and possibly magnitude indicators. I don't necessarily see them as precision indicators,
They
right?
aren't. And that's my point why one has to incorporate technical analysis
Yep.
into the equation, because people can get excited and get more excited. And the same thing with valuations. And that, when you look at these charts, you'll see that in fact, that's what sometimes happens.
Yep.
The good news keeps coming, market keeps trending higher, and people, as human beings, we think in a linear fashion. Time goes in a line. Our brains work in a line. And we have a tendency to think what's recently happened is going to continue to happen into the future. And that's why the idea that markets discount the future is wrong, because markets aren't linear,
Yep.
and the world isn't linear. And
I,
so that's, again, technical analysis, I think, is a must to blend into this equation for the exact reason you cited, Tony, in terms of some precision.
yeah. I post this a lot, Jim. It's called extrapolate today until forever, right? I mean, that's just what a lot of people do. Tracy?
Yeah, I had a question for Jim. Yesterday we saw Nvidia CEO came out and said quantum technology is years away. And we literally saw like 35% pullback, 35% in one day,
Yeah.
and a bunch of these quantum computing stocks. And so, realistically, how much can we, I mean, is this what you're talking about? You know
Yeah.
what I mean? Like, we
Yeah,
can,
in a sense.
somebody says one thing and we get this
Boo.
huge
Well,
pullback.
again, what we've been seeing is people, to Tony's extrapolating the future, but what people are, in a sense, are expecting great things to happen fairly quickly. And that justifies then putting valuations that are somewhat disjointed. I often tell the story about RCA. It was $8 in 1921. And then all of a sudden people start talking, not only are they going to do radio, but they're going to have pictures of people. And television came into being, and RCA traded up, I think, around $560 or something in 29. And by 32 it was down to 15. Did RCA and NBC achieve what the hype was? Yeah, they have radio stations, TV stations all across the land. It just, prices got disjointed. So what you're talking about, Tracy, is that people get into the hype. And what happens when everybody's jumping on the bandwagon, selling pressure decreases. And so it doesn't take a lot of up volume to get disproportionate moves to the upside. Conversely, when the bubble pops, air gets taken out. And what you just described is a bubble pop and air coming out. And I also know that NVIDIA experienced a key reversal day this week. And last spring and summer, it had a number of them, and they were followed by meaningful corrections. So, to me, it's always been not if, but when it becomes a reality that companies are going to start to pull back on their spending on AI because they're not seeing a return on the investment yet. They might 2, 3, 4, 5 years down the road, but at some point in time, you say, well, wait a second, let's kind of slow down a little bit. And obviously, if we see a meaningful slowdown on the economy, that's going to encourage more cost control and more cutbacks in some of the spending.
This always happens, Jim, right? It's the same thing you could say in the telecom or internet bubble, where
Yes.
implementation and the value gain from the implementation had to catch up with the technology capability, right?
Yes.
So we've got all this great stuff out there. While Jensen said quantum is 3 decades away, he also said that Moore's law is broken and we've like 8x'd it or something like that. I mean, the guy is speaking so many different sides of his mouth. It's really crazy. And I think we're in that part of the hype cycle where everyone just laps it up, right?
Yeah.
So,
Yeah.
it's
Again, you want
it's really
reinforcement
strange.
for.
I see that knowing smile on Leo's face as a value investor. So, Jim, I want to go a little bit into the Buffett indicator. You talk about the Buffett indicator as well. And again, this is a good directional indicator, but if you don't mind kind of quickly helping us understand how you use this indicator.
Well, again, it's just another metric of valuation, and it's comparing the capitalization of the equity market to the economy size, GDP. And historically, theoretically, there should be a relationship there. But what we see is at times it gets way above the value of GDP, and in the depths of long-term bear markets, we get below. It's now at about 207% as of a couple of days ago of GDP. If you take a long-term trend of the Buffett indicator, it's more than 65% above it's a historic trend. So these are all signs of valuation. But until a reason to sell materializes, it can be maintained. And
Right.
I think, as you noted, it always goes this way. There will be a reason to sell. And when it does, people will find their pants around their ankles.
Well, and I think part of the problem, just in that one indicator, you look at value to GDP. Okay, let's assume that GDP, the quality of GDP has changed over time, right? Government spending has largely taken over. Okay,
Mhm.
so if we could pare that down to the quality of GDP, valuation to the quality of GDP, and cut out a lot of government spending, then that looks wildly crazy, right? So it's
Yep.
government spending on this stuff. It's not private sector spending on this stuff. It's not investment spending on this stuff. It's government. So if you look at C plus G plus I plus X minus M, that G is a huge portion of GDP. And on some level, I almost think we need to strip that out of this Buffett indicator so that we can see what's really supporting those valuations. And of course, government spends on stuff and everything else, but it's slow cycles and, dare I say, it's corrupt and all that stuff too, right?
Yeah.
So,
Well, the one thing, Bessent, who's the Treasury Secretary
yeah,
nominee, said, well, one of our goals is to get the deficit from 6.4% down to 3. That's $1 trillion worth of spending.
yep,
Is that important that it gets done? Absolutely. At the same time, if the government spends $1 trillion less, what impact is it going to have on economic growth? Things are going to slow. Now, they've talked about, well, we're going to cut regulation and all that, and that's going to help growth. And again, and I have charts of this stuff, under President Biden, he had the greatest number of economically significant rules. In other words, $100 million or more. I mean, he's more than any other president. There's no question that cutting regulation will be beneficial. The problem is that really takes time to enact
yep,
and then for people to respond to it. And so I think there's a time mismatch between some urgency to get the deficit down, because I think they understand that one of the things that's spooking bond investors is supply.
yep.
And so, that goes back to expectations are really high regarding President Trump coming in, wanting to do a lot of things that I think ultimately would be beneficial. But they've got a 2-year window. I
Yep,
mean, the
exactly.
midterms, the party in power almost always loses seats. They got a 4
Yep,
seat margin. And so a lot of the people who voted for a Republican for the first time in their life was because inflation. They remember back in the first term, gee, my rent wasn't as high, food costs were less, my insurance costs have gone up a whole bunch. And very simplistically, these people don't, not big on economics. They'd like to think that, okay, he comes in, he's going to dial back the clock, and my costs are going to come down to where it was a number of years ago. Well, that would take outright deflation. That's not going to happen unless we have a real recession, which isn't going to make their lives any easier. So I think that's
yeah.
the
It has
challenge,
to.
is they got a 2-year window to accomplish a lot of stuff. And if they lose the House, it'll become immensely difficult to really, if you will, make a footprint that has a long-term lasting impression.
Yeah, deflation would have to affect services wages to be meaningful, first of all.
Yep.
I also believe that Trump and Bessent and others are trying to get foreign investment to replace a lot of that government spending. It's a shell game, right? It's on some level it's zero sum, but they have to have it zero sum plus. So, and
Yep.
deregulation, the half-life of deregulation is measured in years. It's not measured in months or weeks or days. So they can come in on day one and deregulate a lot, but you have all this inertia within companies and within government entities that will keep it from changing the kind of implementation and enforcement of it for quite a long time, because we have those behaviors in place. So while we want this stuff to happen quickly, I just don't know how quickly it's going to happen. Sentiment will change. but
Right.
will the actual actions change? So Jim, I want to move on to a little bit to, you mentioned the potential for a secular bear market with declines of 20 to 40%. So you mentioned that a little bit, but can you elaborate on the key indicators that signal we're heading into that kind of a phase?
For me, we've covered obviously sentiment and valuations because historically, as we saw coming off the highs in 2000, 2007, declines of 50%, obviously 73, 74. So secular bear markets, there have been four of them, Tony, since 1906, 1929, 68, and obviously 2000. And these things last 10 to 15 years. And part of it is that there are problems that build up during a secular bull market that need to be addressed, and it takes a while. And the tools that have really shortened recessions in the last 40 years have been the combination of fiscal policy and monetary policy. And in the 1960s, each new dollar of debt generated 90 cents of GDP. It's now down to about 30 cents.
Yep.
So in other words, we have to spend ever more and more and more. And at the point in time, we're at 36 trillion in debt and rising by a trillion every, 100 days or so.
Yep.
Interest expenses consuming are ever. So my point, there's the straw that breaks the back. We're nearing that time where we really need to do something, which will limit fiscal policy, monetary policy. For decades, the Fed regulated the economy by raising and lowering the real rate of the funds rate. Well, starting in 2001, they went to negative territory for chunks of time. And then in 2008, they went to quantitative easing.
Mm-hmm.
So my point, to me, the inference here is monetary policy is requiring greater doses and imagination to get the same economic outcome.
Absolutely,
so the two
yeah.
primary tools, I think, have kind of been neutered a little bit. And so if we go into any kind of an economic slowing period, I'm not sure they'll do what they can, but they may not have the same impact on the economy.
Yeah, I think it's policy efficacy, but I think it's also productivity of the workforce, right? And so we have guys like my age and your age who we're not as productive as someone Leo's age or Tracy's age, right? And so, there's a lot of people who are getting to that point where, quite frankly, we're not as productive, and we're on the, not me, but guys like you probably on the border of retirement. I don't think I'll ever be able to retire, but it's people don't necessarily want to work that hard in the last, say, 5 or 10 years of their of their career. You're accepted, Jim, of course. We know you work 18 hours a day, but it's just, I think the productivity of labor is somewhat problematic, and making these changes are going to be really painful, and they're going to have to happen at some point. So you did mention the 30-year Treasury bond price. You put a tweet out about this. I think it was yesterday.
Yep.
And can you tell us a little bit about that tweet and the 30-year bond and this secular bear?
Yeah, I explain it more in this piece I mentioned at the beginning. Basically, the bond market has had secular bull phases, bear phases that seem to last 30, 40 years, effectively from 1946 to 81. Secular bear market yields went from about 1.5 on the 10-year to over 15, from 81 to 2020, from 15 plus to 55 basis points. And the main thing in looking at the 30-year Treasury bond is that during that secular bull phase, it adhered to a trend line that was broken. So that's the first warning sign. The other thing, if you look at the Treasury bond going back, you'll see 5 waves down from that high in March. And so from a pattern analysis point of view, 5 down or 5 up, by the way, would indicate you're going to get another move in that direction after any intervening bounce. So, my take last October of 23 was bonds were set up for a big rally. They've had a big rally. We're now at I think, a critical point where bonds need to dig in if we are going to see one more phase of this counter trend rally above the high we saw in September. Irrespective of whether we get it or not, Tony, what the break of that chart and the 5-wave down implies to me is we're in a period where long-term interest rates are headed higher. And at a minimum, the 10-year, I think 7.5% is a reasonable target. And obviously,
Stop.
well, here's how
Oh,
it happens.
that's huge. That's
Jim,
even bigger
you're
than.
killing me.
But think about this, okay? So my thought here is that why we're at a litmus test here or a critical juncture is if the economy slows, as I think is more likely, given the bullishness about the economy, inflation comes down not to 2% per se, but comes down in the coming months. I think that's how you can get a rally where TLT, for instance, goes above 101 and change. But if we go to a recession, what's going to happen to the deficit? It's going to explode. And that amount of paper, I think, can become problematic. In addition, I think the dollar could be putting in a very important high as long as it stays under 110. And the price target then on the dollar is under 95. So to me, all this stuff, we're talking 2, 3 years or longer down the road, potentially, but a lot of supply and a weaker dollar, I'm not sure that's the kind of thing that causes. And if inflation doesn't come down as enough, there's enough things in the mix that could justify why we could see Treasury yields take out their highs from last October and then obviously go materially higher.
Yeah. It's Basant's biggest challenge, right? And
Yeah.
I think what we see based on the chart that you're showing is that bond investors don't believe in MMT effectively. I mean,
Right.
to me,
Right.
that's the quick bullet point takeaway from that is we've tried MMT, we've come up close to it, and bond investors just aren't believers. Maybe they're all over 50 and they just, don't believe in, ongoing returns from the world reserve currency or whatever, but it's just not infinite. And bond investors, again, at the end of the day, bond investors kind of rule the world. And so we really have to follow what,
Yeah. And the rise in interest rates is global in terms of what's happening in Germany and even Japan and so forth. The one thing is the perception that tariffs are going to be inflationary and mass deportation is going to boost wages. I'm not convinced that we're going to see it to the degree that people are talking about. But the bottom line here, people use a 60-40 allocation. And what I've written about the last couple of years, actually in the summer of 21, was that we were entering a period where bonds and stocks would break down and revert to their longer term pattern. Longer term, for many decades, bond prices and stock prices went up and down together. Then from 2000 to 2020, stocks went down and bonds rallied. And so for a lot of financial planners who've been in the business 20 years, that's kind of what they know.
Yep.
And my point is that secular bear market can do a lot of harm to portfolios if indeed rates work their way higher over time, and they're not going to provide the protection that people are anticipating and expecting if indeed we see a meaningful decline in the stock market. And, a secular bear market that I'm thinking 10 to 15 years. And it's not going to be like 29. I think it's going to be much more zigzagging all over the place. We'll see policy responses that will generate big rallies. But at the end of the day, I think there's some serious problems that we're going to have to deal with, which ultimately equates to slower economic growth.
So we have more sophisticated, say, markets and derivatives and securities than we had
leverage.
in 29. So it's not it's not the same thing, but it's similar, I guess. I'm not saying this is imminent. I'm kind of taking your analysis, which I think is hugely valuable. Hugely valuable.
I mean, there could be still, let's say the economy slows, the Fed starts cutting again sometime this year. Could there be one last big hurrah rally? Yes. But what's been happening in the advanced decline line the last month or so, historically, prior to big declines and bear markets, is you get a divergence between the advanced decline line and the S&P. So in 22, when the S&P made a new high in January, the AD line didn't confirm. 2007, same thing happened. I mean, I'll go all the way back to 29. So to me, these are the.
Well, you already said 1906, Jim. So, I mean, I didn't even know we had money back then. So,
well, there was, and some of the things that happened in 1907, I think there was a railroad problem, led to the formation of the Fed in 1913. anyway, my point is the technical underpinnings have weakened significantly, which is ironic because cyclical stocks have been quite weak. And we have at the same time this narrative that the economy's in good shape and Trump is going to make it better. There's a disjoint.
Possible,
Well,
but maybe not.
those stocks aren't behaving that way. You know, I
Right.
think people are going back and have gone back the last few weeks, the mega cap stocks, because they look at that as all weather stocks.
Yep.
And, you know, that's going to be proven wrong.
Speaking of all weather stocks, Leo has been really quiet, and that scares me because I know he's deep in thought as we talk. So, Leo, it's great to have you back. Thank you, Jim, for all of that. That's
Welcome. Sorry I ran a little long, but, you know,
No, it's
appreciate
great.
the
No
time and
problem. That was
opportunity.
great.
It was, and yeah, it's great, and it sets us up perfectly to talk with Leo about dividends. So Leo, you recently published an article titled "Buckle Up, Buttercup: My Warning to Dividend Investors on Seeking Alpha." It's a great piece. You've got, I don't know, 15 charts in it. It's really well documented and validated. You discuss the Fed's recent rate cut and its implications for persistent above average inflation. Can you elaborate on how these policy decisions might impact dividend investors currently and in the near term?
Yeah, well, thank you for having me. And the great thing, I mean, Tracy and Jim both brought up a lot of the stuff that I want to discuss as well. So it's a perfect foundation. I think in general, you know, since the pandemic, as I've always said, you know, inflation will come down. I mean, inflation was at 8% or something, so obviously it had to come down, but it won't normalize. And normalize is basically, you know, 2% what people, you know, were expected, because we had it between the Great Financial Crisis and 2021, which was really one of the best periods ever for stocks because you had, you know, oil and gas production was so strong. You had, you know, globalization, you know, cheap production from China and all this stuff. That was fantastic for the stock market, especially growth stocks. And now the market is figuring out that we don't have these tailwinds anymore. And even worse, I mean, goods have been in deflation for a while. And service inflation were mainly driving inflation. Now you're seeing another uptick in ISM services index a few days ago. And so many indicators that inflation is really, you know, settling above 3%, which is, you know, not what the Fed wants to see. So it basically looked like, okay, one last rate cut last year, and now, well, basically, I think the consensus is 0 rate cuts this year. Trump obviously won't like it because he keeps commenting on he wants lower rates. And that could be an issue because, you know, in this piece and in many other articles, I talked about valuation. And, you know, we spend in this podcast a lot of time talking about valuations as well. And I think the biggest 10 stocks in S&P 500 are now, I think, 40% of its rating. And I think we talked about this a few months ago as well, and then it was 32 or something. And, you know, it can get extreme because, you know, valuations don't really matter until they do, until one of these companies, at least the bigger thesis, turns out to be faulty. But the risk reward doesn't get better. And I mean, obviously everyone has been buying, you know, these Mag 7 stocks because even if rates go up, they still don't get hurt because they have so much cash. You know, when the Fed started hiking rates, you know, they made a lot of money on the cash side on the balance sheet. So not even these higher rates hurt it because, well, they're still growth stocks. They're not the kind of growth stocks that lose money and are expected to make money, you know, 10 years from now. So there are really no reasons to bet against these companies. And at this point, there still are not a lot of reasons to sell them. It's just about the risk reward at this point. And I think there are many issues, like AI really needs to pay off. They've invested, I mean, they've basically created an entire industry out of thin air the past few years. You know, AI wasn't really a thing, and now it's a multi-trillion-dollar industry that could, I don't know, some say be bigger than the Industrial Revolution, at least, you know, as big, or at least close to a range. Yeah, and now it needs to pay off. So I think, I don't know if it was Steve Ballmer who said, you know, companies like Microsoft, they will invest in CapEx until they run out of money or shareholders put a halt to it, which is a weird statement, but, you know, that's where we are in this environment. And when you look at growth expectations, I think at the end of this year, the biggest 10 companies are expected to grow EPS by 21%, and the remaining 490 companies are expected to grow by 15%, which is an interesting development because you're paying 31 times earnings for the big guys and I think 18 times for the rest. So from risk reward point of view, it's really hard to make the case that people need to jump into these big cap companies, mega cap companies. And that's especially in light of, inflation being sticky. And that's why I said, in the article, really focus on companies with healthy balance sheets, and on beaten down companies. Because I don't know, Jim brought up a great point. We could be looking at a prolonged secular bear market, and that would be devastating for people who are now piling into what could be overvalued companies. So I would say focus on companies that are cheap in this environment. There are quite a few that are still cheap because all the money went into these big companies. Healthy balance sheets, and what I like, secular growth story. I really want companies that bring something special to the table, and I think there is a lot on the markets right now that is quite attractive, that we can talk about as well if you still have time.
Sure.
Yeah.
Leo, you mentioned a bit about EPS expectations, and you included this great chart from JP Morgan. So can you talk us a little bit through the EPS and margin expectations, and do they seem realistic? And what does that mean for dividend investors? What, the plausibility of those EPS and earnings expectations, and margin expectations, what's the specific impact on dividend investors?
Yeah, I mean, it's quite interesting because the market valuation is lofty, but it's also based on high earnings expectations. So I think this year, JP Morgan, and I think it's based on consensus estimates, they expect 13% or even 15% earnings growth. And that's obviously mainly driven, at least mainly driven, but a big part of it is driven by the Mag 7. But it's quite interesting, even after 2025, they expect in the mid-teens growth. So these expectations are quite high, and now the economy needs to deliver. And when you get into this environment, higher for longer, that could stress the economy, especially borrowers. And so that's the risks of these companies underperforming is rising, and at this rate every day. And that's one of the reasons why I want companies that are less prone to these issues, with healthy balance sheet. And for dividend investors, I mean, I invest all of my money in dividend stocks, and I talk about it all day, but it is really hard. I mean, I wouldn't put dividend stocks in one group. I mean, there are even a company like Broadcom and Apple, they're dividend stocks, and obviously there are value stocks like Altria, cigarettes, and that haven't done so well for more than 10 years. I think people really need to be picky. That's why I said, for a few family accounts, they invest in S&P 500 ETFs, which is never a bad idea, but we are shifting more money into value-oriented dividend stocks, which have underperformed the markets for the past 2 years. But if you zoom out, they bottomed relatively to the S&P 500 in 2021. And if it weren't for this AI tailwind that happened, I think in 2023, I think they would have kept outperforming. It was really this AI move that brought everyone back into growth stocks, supported by falling inflation and improved liquidity. So I think, to beat the market, different investors and investors in general, they don't have to take wild risks. I think it's, ETFs like SCHD, the Schwab dividend ETF, stocks like these, I think they're very likely to outperform the market. And areas like, energy, obviously, and Tracy also mentioned midstream. I really like the midstream players. I've talked about them for many years. I think these companies offer really high yields, but also reliable yields. They're not the sucker yields that you get when you buy yields above 6% usually. And real estate, real estate is in a tough spot, the real estate investment trust. I don't expect them to skyrocket in the next few months, but given where they are trading and how they were punished by the surge in longer term yields, I think there was a lot of value there.
Okay.
And personally, I always talk about it. I really like landowners. I was one of the first to cover. Probably, I think I was the first who wrote an article on the entire internet on LandBridge when they went public in the end of June. It's a landowner, just like Texas Pacific Land, who own land in the Texas Permian. And they are categorized as an energy company, but they don't produce any oil and gas. They just own the land, and they have surface rights, water rights, and mineral rights. So they make money on everything that happens, on the royalties, on the water, and it's a fantastic business because Landbridge doesn't spend a penny on capex. It's just, they have the companies drilling on their land, so they make royalties, but it's just 20%. The rest is really focused on the water business, produced water, which is becoming a bigger issue. So they have pipelines on their land, which are operated by Waterbridge, but Landbridge doesn't spend any money, and now they're preparing for a much bigger move into data centers, because that's probably one of my favorite themes, investment themes, data centers. But I don't want to invest in the chips. I don't like Nvidia at these levels, and I don't want to own the real estate companies who own the data centers. I'm just not a fan, but I want to own the land, right? So what Landbridge has been doing, they've built contiguous land because it's fantastic for data centers in Texas. If you look at places like Virginia, where I think a fifth of all data centers are located in the US, or even more, probably even more. There are now wait times of up to 8-9 years because they don't have the power for these companies and the infrastructure. It's just not there anymore. It is, demand is so high, and I think that demand is still underestimated. If you look at what these big companies are up to and how far these developments are going. So the Permian and Texas in general is fantastic for these data centers because they have the cooling water, they have the power, they have good data networks. It's fantastic for the company. So that's why I think 35% of my money is now in Landbridge and Texas Pacific land, because I think it has energy, high quality land, the water tailwinds, and data centers. And I think that's for the next 10-20 years, a fantastic place to be. And in general, when it comes to dividend stocks, I look for these stories because I really agree with Jim. The next 10 years won't be as much fun as the past 10 years. And I don't know what the returns will be, but I think in order to outperform, we don't have to take huge risks, but by moving some money around, it should be possible to generate income and capital gains and probably beat the markets over time.
Interesting. I remember hearing after 9/11, U.S. financial regulators told the banks that they had to move their data centers out of New Jersey and New York. And so a lot of them moved just north of Dallas, and they didn't trust the power grid. So they built their data centers right on top of Natgas fields. So they could have
on top of Natgas pipelines. This is why I love midstream so much, because what's going to happen, we're going to see is, there are only we don't have that many 3-mile islands that you could reopen. So
exactly.
It's not like we have this cache of nuclear that we can reopen. And so, but what we can do, and quickly, is build natural gas pipelines. And those companies can tap right into the pipeline. They don't have to go through the utility companies. It completely takes out the middleman. It makes things cheaper for everybody and does very well for the midstream energy
and the local communities, right?
And
the communities that don't have
absolutely, because you have a ton of jobs built around it.
Ton of jobs, middle of nowhere, right next to a nat gas pipeline. They don't have to worry about the power generator risk. It just sounds like a great formula, Leo, and I think that's an amazing kind of analysis on those types of companies. So I would recommend people check out Leo's article. I'll put a link in it in the description. Jim, if you want me to put your presentation up, I'm happy to put that up with our video. Tracy, you can always find Tracy on Twitter.
I can put my last presentation that I gave out on at the New Orleans Investment Conference. If you are interested, we can put a link to that presentation.
Great. I'll put all those links in the show. So guys, thank you so much. I know it's beginning of the year, everyone's busy, but I think this has framed up the year excellently. So I appreciate this and have a great day. Thank you.